To keep your body healthy, you need a balanced diet. The same is true for your money. If one company goes out of business, you do not want your entire life savings to vanish with it. The problem is that buying individual shares of 500 different companies is like trying to buy every single raw ingredient to cook a massive banquet from scratch. It takes tens of thousands of dollars and hours of exhausting work. We all know the golden rule of investing: don't put all your eggs in one basket. But that advice is terrifying if you only have enough cash to afford one egg. Enter the exchange-traded fund, or ETF. Think of it as the ultimate variety pack. Instead of buying individual ingredients, you buy a prepackaged box that instantly solves the problem. With a single click, an ETF lets you own tiny, fractional pieces of hundreds of companies at once. It takes a small amount of money and instantly spreads it across the broader market. Mutual funds have offered this kind of package deal for decades. But using a traditional mutual fund is a bit like hiring a hands-on personal shopper to pick out your groceries. You have to pay heavily for their time. This comparison shows the difference in fees. On the left, a mutual fund might charge up to 1.5% to actively manage your money. On the right, because most ETFs simply track a preset list of stocks, they charge a tiny fraction of that, often around 0.05%. There's also a hidden cost. When a mutual fund manager sells stocks inside the fund to buy new ones, it can trigger a profit that the government wants a piece of. Even if you didn't sell your shares, you still get hit with the tax bill. The ETF's automated structure mostly avoids this, keeping those extra costs away from your mailbox. By skipping the hefty management fees and those extra tax bills, the invested money inside an ETF has the room to grow significantly faster over a period of decades. There's also a major difference in speed. If you want to buy or sell a mutual fund, your order sits in a queue. The final price is only calculated once a day, after the market closes. ETFs work entirely differently. They trade exactly like individual stocks on a public exchange, like the New York Stock Exchange. This gives you total flexibility. You can buy, sell, or trade your ETF variety pack at any moment the market is open. You can watch the price fluctuate from 10 in the morning until the closing bell. An ETF takes the wide, safe diversification of a mutual fund and marries it to the immediate speed and visible pricing of a single stock share. Before buying one of these variety packs, you need to read the warning label. First is market risk. A variety pack of stocks is still made of stocks. If the entire global economy crashes, your ETF will decline right along with it. This chart shows what is known as tracking error. The solid blue line is the market index, while the dotted green line is the ETF trying to copy it. Because of minor administrative fees or holding small amounts of cash, the ETF's performance might drift slightly away from its target. Zooming in on that green line reveals the spread. This is the tiny gap between what someone will sell the ETF to you for and what they will buy it back for. For a popular stock market ETF, that gap is just pennies, like buying everyday milk. But if you buy a very niche, specialized ETF, the gap is wider. It's like an imported specialty snack that costs more just to get in your hands. The ETF is a highly efficient container, but how safe it is and how cheap it is to trade entirely depends on the popularity and stability of the assets packed inside that box. Today, that variety box container is used for almost every type of investment imaginable, moving far beyond the standard stock market. Take commodities. You can now add physical gold to your portfolio by typing in a simple digital code on your phone. You don't have to buy the heavy bars or hire security for a vault to hold them. Compare that modern digital ease to how things used to be. Decades ago, if you wanted to invest in government debt, you had to hold on to physical paper certificates like these. The sheer convenience of the ETF model has caused a massive shift. Going into 2026, the global ETF market has crossed $20 trillion in size. In fact, many older mutual funds are now converting themselves into ETFs simply to keep up. By wrapping complex, expensive markets into a cheap, easily tradable variety box, ETFs have made it possible for anyone to start building a portfolio with just a few dollars. You no longer need to buy the whole farm. You just need to choose the right box.